Hello, everyone. It's Brandon Baines from Wealth Builders. I'm your presenter today, and this training is going to be about FHA financing. Bear with me as I start to work through my actual training and get you guys started and show you guys what we have to offer about FHA financing. So FHA financing, we're going to start off with this. What is FHA financing? FHA is a federal housing administrator that provides mortgage insurance or loans made by FHA-approved lenders. FHA insures these loans on single and multifamily homes on all 52 states. They are the largest insurer of the residential mortgage in the U.S., insuring millions of properties since 1932. So pretty much when you sit here and you say, hey, I need to get an FHA finance mortgage, that's really just an insurance company that protects their lender to make sure that they get their money back when they're purchasing or acquiring a home. So that's one of the financing options. The loan requirements for FHA, which Ty will get a little bit more in depth about, is your FICO score. So FICO score ranges between 500 and 579, which equals a 10% down payment. You also have a FICO score between 580 and above is 3.5% down. FHA is one of the, I guess the best way to phrase it is the least amount of money that you need down in order to purchase a home. With an FHA loan, you are required to pay what is called MIP, which is mortgage insurance premium, and that is required for the life of the loan. Your debt to income ratio cannot be greater than 43% in most cases, and we'll get a little bit more in depth about what's the requirements for the debt to income ratio, how do you calculate your debt to income ratio, all in this PowerPoint presentation. So this will give you a little bit more in depth on calculating your debt to income ratio and actually knowing what's included in your debt to income ratio. And I'll also give you some pointers on how you can absolve some of your debt and qualify you to purchase a home and get more, it's the best way to phrase it, to get more buying power. Another requirement for FHA is the home must be the borrower's primary residence. So in that case, that means that you have to be living in that house. You cannot buy the house as a rental income property or an investment property. It has to be your primary residence. You have to be living there. Now, if life changes, then of course you can move, but your primary focus on that house, it has to be your primary residence. A borrower must have steady income and proof of employment. Typically, most lenders are looking for 2 years of applicable income. If you are a 1099 employee, they're looking for 2 years within that field, and you can do bank statements to show your income. And then what they'll do is they'll do the split. So say for instance, 1 year you make $150,000, and the next year you make $50,000. They'll take that median income, which would be about $100,000 per year, and that's what they'll use in house as your income. So that's just a little point for you. But if you are a 1099, a W-2 employee, all they need is 2 bank statements. Two payroll checks, and they'll be able to qualify you through that. And they also do it before taxes, so that means that they don't even include taxes coming out your check. They can use your net income as qualifying income, even though you're not getting all of that income to your bank account. FHA loan credit issues. So some of the reasons some people may disqualify or might not be able to purchase a house is due to some of these reasons why you wouldn't qualify for an FHA loan. Bankruptcy, Now, keep in mind, bankruptcy does not disqualify a borrower from obtaining an FHA insured loan. For Chapter 7, at least 2 years must have lapsed and the borrower either reestablished credit or does not incur new credit obligations. So you just have a 2-year time frame, so don't look at it like it's forever. What I would use is that time. If you file bankruptcy, use that time to actually build up your savings so that you can prepare for a hefty down payment, and also so that you can create a better quality of life, because the better your down payment typically can help you. And also you can save money so that you can buy down your rates and buy down your points. Late payments. Typically, buyers should have at least 12 months of on-time payments on all financial obligations, and that's everything that you pretty much report to your credit bureau. When thinking about that, you don't want to have any late payments, because the bank will look at you as more of a faulty, that you're at high risk. Lenders do not like to lend money on high risk loans. That's typically where you get the higher rates, or typically it's going to be hard to qualify and you still get higher rates. And then you can also can't buy certain points on your interest rate. Foreclosure. Past foreclosure is not necessarily a roadblock to a new FHA loan, but it depends on your circumstance. So depending on how you file for your foreclosure, whether it's a short sale, or it got completely foreclosed, depends on the guidelines. You have to talk to your lender in regards to find out what the foreclosure procedures are when you're trying to purchase a home. Collection judgments and federal debt requires the lender to determine that judgments are resolved or paid off prior to closing or at closing. So when you're thinking about that, for my buyers out there, you want to start putting yourself in a position where you're paying off your collections, your judgments, and your federal debt. One thing most people don't know about collections is if they're medical collections, they're very easy to get off your credit report, and they're very easy to not have to pay. So when you're thinking about, oh man, I have to pay all this money in order to get my home, I have to pay off $10,000 worth of medical debt. There's a very easy way to get that off. And Ty and our credit repair courses can actually educate you on what you can do about your medical reports or your medical collections coming off your credit report. Judgments, as we all have had different types of nuances in life, judgment is pretty much a lien against yourself that you just owe some money to somebody and it's court ordered that you have to pay it. This typically this has to be paid, and you can set up an agreement, but typically it has to be paid off before you can purchase a house, unless you go through different other avenues of getting a loan. FHA loan is not the only loan that's out there. There's other avenues of purchasing a house without having to go through an FHA loan if you want to avoid paying for judgments. Federal debt, that's pretty much just your typical student loans. Typically, they look at 1% of your debt in order for you when they qualify you for a mortgage. So 1% of whatever your student loan debt is what they're going to calculate into your debt to income ratio when you're looking at purchasing a house. So the benefits of an FHA loan, which our philosophy is you buy when you qualify. So most lenders will tell you purchase when you qualify, because at the end of the day, your buying power could drastically change. New lending guidance come out every year. So you may be qualified to buy now, but next year something could change in the lending laws that could disqualify you to purchase a house. As well as you also have to keep in mind that your buying power also changes as well. Buying power can typically come from interest rates increasing, because of low inventory, house prices going up, or lack thereof of inventory. So you buy when you qualify. The benefits of FHA loan is easier to qualify. FHA typically has the highest debt to income ratio. I know that on my previous slide, it said 43. You cannot have a greater than 43% on debt to income ratio. FHA goes as high as 50% on a debt to income ratio, but there are certain circumstances that would qualify you for it. I do have a slide at the end that will tell you exactly what is needed in order for you to qualify for your to be calculated in a higher ratio of debt to income ratios. So FHA provides mortgage with lower requirements. This makes it easier for the borrower to qualify even if the questionable credit history and low credit scores. FHA does give you a competitive rate. So typically when you're out here and you're shopping for a house and you go conventional, your conventional rate, let's say for instance, if you were quoted a rate on conventional at 3.75, you could actually probably qualify for a conventional loan, FHA loan at 3.5. So it could be as much as 0.25% on your loan. But keep in mind, when you're actually qualifying for FHA loan, don't forget that it is the minimum on your credit report. It's the minimum on down payment. And they do typically have more of a competitive interest rate. But you do have to pay MIP, which is that mortgage insurance premium for the life of the loan. So as long as you have that house and it's under an FHA mortgage, you will have that MIP. So when you're thinking about that, you want to determine that. Also for FHA loan, the credit history, they take higher risk loans. So you can qualify for an FHA loan for a credit score as low as 500, compared to conventional starts at minimum at 620. So that means you have to have a minimum credit score for a conventional loan at 620 credit score in order for you to qualify for a loan. So your down payment can be taken as little as 3.5% down. Conventional usually requires 20% down. Depending on your lender, you can actually find some down payments on conventional for as low as 1%, and then the lender will gift you the other down payment. So when we talk about credit and how important it is, credit does give you a lot more power to purchase in a house, as well as it helps keep money in your pocket. Whereas for typical buyers, you can actually have more income in your pockets. For instance, Guild Mortgage, which is a lender that I do work with here in Atlanta, Georgia, they have a 5% gift. So 2% goes towards your closing costs and 3% goes towards your down payment. And then if you like to bring you have to bring the regular. It takes about 4% to completely cover all of your closing costs. You have to bring another 2% towards closing costs, but that's it. So you're pretty much in a house at 2% down to purchase the house, and you're going to get a competitive interest rate. This program is very unique. You do need a 660 credit score, and the max income you can have is $103,000. And you can take these funds from approved sources such as your savings account, money saved at your house, an investment. You can also cash out, or you can also get gifts. And gifts, typically you have to show where the money is sourced from. So if it's come from your parents, they have to all show bank documents pretty much showing that money was sourced from them or provided by them. And they also have to write a statement stating that you will not repay that money back. Mortgage insurance. Conventional loans usually require the borrower to pay private mortgage insurance if you don't provide a minimum of 20% down. FHA is a little different. They require the payment of an upfront mortgage insurance premium and annual mortgage insurance. So the upfront will be paid at closing. They'll pay the entire mortgage insurance for the entire year to make sure that the borrower is done. And that's going to be all in your escrow at your closing. And then they'll divvy that out as it goes on the rest of the year. And then following year, you'll have to pay it monthly. Oh, sorry, guys. So FHA loan limits. FHA, it has a loan limit that is calculated, and it's the maximum amount of money that you can borrow based on this county and within your state. So each state has a different FHA loan limit or county. It really does depend on where you are living at. It will depend on your maximum loan amount. They're called the FHA lending limits, and this is just if you were interested in like a duplex, a single family duplex, a triplex, or a fourplex. And this is like low cost areas. This was for 2018. So when you're looking at this, as you can see, in this area, it's $294,515 for a single family home. For your FHA loan limit, for a duplex is $377, for a triplex is $455, and for a fourplex is $566. So based off of your county or your city will depend on what your FHA loan limit is. So for instance, if you were purchasing in New York City, your FHA loan limit would be a lot higher than you purchasing in, let's see, I'm trying to think of a small city, Macon, Georgia. Due to the demand of how much the average sales price is for that area or that city, it's going to be a lot cheaper. It's going to be drastically cheaper to get an FHA in the amount of the house or the cost of the house, because New York market is expensive. So you're looking at a townhome, a one bedroom, probably starting at about $500,000 compared to, and Macon, you're probably looking at a house, a single family house, and you're probably talking about $250,000, $300,000. So that's a drastic difference between what your FHA loan limit here. I believe in Atlanta, Georgia, I think our FHA is around like $453, and I think they're supposed to be increasing to $480. Don't quote me on that, but I believe that's around the numbers. But each city and each county is going to have a different loan limit, so you do have to check with your, check with your lender. They'll definitely have that information. They'll be able to provide a lot more in greater detail in regards to your loan limits. But if you are looking to acquire a property with an FHA loan, you need to know your loan limits depending on what you want to purchase and how much you're trying to purchase and what your buying power is. Closing costs. While FHA requires define what closing costs are allowable that charges to the borrower, here are the specifics about what is determined in each FHA loan. The lender origination fee. So a lender origination fee is pretty much what the lender charges you to do the loan. It's what the lender gets paid. Some lender origination fees are higher. Some lender origination fees are lower. You can see a lender origination fee of as low as $675. You can see some as high as $2,000 to $5,000. It really depends on the lender, maybe how difficult your loan package is, but there's definitely a loan origination fee. This will all be provided for you by the lender in your lender form, and I will also provide a downloadable form that will show you and allow you to be able to see what a breakdown looks like for a proposed closing date based off of the geographic area in Georgia. Just hit me up on email and I'll be able to provide that for you. Deposit verification fee. This was what I was talking to you guys about in regards to lender getting a gift. So for instance, say for instance, your mother or your father want to gift you $10,000 to purchase a house. Well, you need a deposit verification fee sheet that shows, that proves that where that money came from, and a lender has to go through a certain company in order to verify that, and they may charge you a fee for that. So they can charge you a fee to verify where that deposit came from. Typically, I try to tell people to make sure that you do talk to your lender, verify what their requirements are, how they can do it, because they may have to figure out where their money originated from. Attorney fees are typically in Georgia, they're common. I believe in New York, they're common. The only difference is if you were in Las Vegas, for instance, that's a title company state. So instead of having an attorney close your home, you would have a title company close your home. So it just depends on your geographic area where you would either see that as an attorney fee or a title fee. Your attorneys are the ones who pretty much do all the hard work to make sure that the land is where it's is at, and they're typically called closing attorneys. They make sure and verify that the title is clear, who owns it outright. They're going to do all the back work. They're going to the courthouse to make sure that the property is listed under, and they're going to trace the title all the way back to as far as they can go, to make sure that that land has clear title. So keep that in mind when you're thinking about what you pay for attorney fees, and you're also getting insurance for your home. Appraisers and inspection fees. So appraisal fees, that is going to be part of that's going to be included in your closing costs. You do pay your appraisal fee. Inspection fees is when you go out and you send somebody to inspect your home, you can put that into your loan. And some lenders actually do pay for some of these fees depending on the lender. They may offer that to you. But you might have to have document preparation. Lenders can charge you for that by the third party. Property surveys. I always recommend people to get a property survey on your home due to the fact that, for instance, if you have a what is the word? A pipe, a water pipe going underneath your property, or a gas line going underneath your property, and then say, for instance, it's going right in between your home, then that land or that pipe has to be accessible to the city. So if they ever had to dig up that pipe, they can destroy your home, and you really have no standing. You can't control it. You can't stop it. It's going to be an easement against that land, and they're going to have that requirement. So when you get a property survey, what that does is let you know, to make sure to concur that that value of that house is what it is, as well as, are there any easements on my property that are my physical home that would affect my home or my home value. As well as, you also want to make sure that people make mistakes. Sometimes people put things on your property that may not be yours and that they're using. And if they utilize that land for a certain period of time, they actually can automatically get an easement to utilize it because they've been using it so long. So these are the type of things that you have to be aware of when you're thinking about getting a property survey. I always recommend my clients to always get a property survey, to make sure that they are protected, to make sure they know where their land ends, what is their land, and also to make sure sometimes that the house is on their property. There's been instances where builders have sold plots of land, and through the legal description, they're buying the proper land. But through the survey, they're surveying something totally different. And then you're buying land, and then they're selling it. And then you have to wind up figuring out who's going to get the house. And your loan can't go through because the land has not actually been sold to that particular person. It's still owned to the other party. And then they might not want to sell a house. Or they may keep the house and charge you a fee. So these are the types of nuances that can happen in property surveys. There's also been a property that was in Virginia Highlands, which is, I don't know if too many of you guys know or from the Atlanta area. Virginia Highlands is probably one of the most expensive areas in Atlanta, besides Buckhead, where pretty much a tear down house could cost you about $500,000. I mean, literally $500,000 for some dirt. You got to tear down a house because the house is not even habitable. And they had an easement on a pipe that actually led on the physical, underneath the physical structure of the house. And that house was going for $1.2 million. But the lending company wouldn't give the loan out due to the fact that the house had an easement for the sewer line to go underneath of it. So at any given time, they could destroy the house. So the land's not worth $1.2 million. The land's not worth half of that. So people had to look at it and say, well, do I want to pay this whatever they're going to give me for the value of the land and pay the difference to buy the house. And the buyer walked away. So it's very important for you to get a property survey to make sure that you know exactly what your land value is. That's probably one of my favorite ones. Inspections are pretty good as well, but it's third party. They're not licensed contractors. I don't like to speak bad about them, but they aren't licensed. They're not builders. Sometimes they don't know state guidelines. They're good to give you a good preview, a snapshot of what the property has been through, understanding your systems, understanding where certain things are. I do love them for that, but I do kind of over exaggerate on property surveys over inspections, because you can kind of eyeball some of that. But you still should get a licensed profession on either cases. Credit reports, they pretty much generally cost you the extra cost of a credit report. Every lender is going to pull your credit report. Keep in mind that you do have to be mindful of what you're looking at for a credit report. And when you look at most of these consumer-based credit reports, they are typically going to tell you what they provide and what they do. So let's talk about Credit Karma, for instance. There's a lot of people that come here and say, "Hey, Brandon, I've seen your Credit Karma. I seen my Credit Karma, and I'm at a 720 credit score." Well, Credit Karma is actually a consumer-based credit company. So what they do is they can hike the points from 30 to 80 or even 100-point difference. So it can be that drastically different because they gauge the system different. Some credit companies actually use an older system to calculate your credit score, and they actually have it stipulated in the bottom part of their credit sites. Hey, our points could be generally off by 80 or 50 points. And they typically know that, because what happens is, what makes buyers happy or people happy is they see a higher credit score going up and up and up. So it makes you happier. So you want to see happy things. And that's what they report to you. They're going to report to you that your credit's great. But then you're going to start applying for these credit cards and they're going to say, no, decline, decline, decline. Why am I getting declined for all this stuff? It's because they're not reporting your actual true credit report. As well as consumer credit is totally different from lender credit. It's a totally different guidelines. They pull from a totally different credit report. You can get yours pulled. You just want to get a company that's not consumer-based. It's easier to qualify for consumer-based stuff than it is going to be to qualify for typically your home or stuff like that. Transfer steps, recording fees and taxes at closing costs. You are going to have to get your deed recorded with the county, and taxes have to be paid. So that's all going to be paid at your closing costs. If you had to get a test on your soil or anything like that, that can be included in your closing costs, and certification fees and home inspection fees up to $200 can be included in your closing costs. Loan checklist. So typically, as you're about to acquire your home, lenders and sellers and the closing attorney have to do a checklist and provide you with certain disclosures and fees that are required before your title or deed is transferred to you. You're definitely going to have to show proof of a valid ID, which is typically state. That's required in all closings, and you have to have it. Title insurance. Title insurance is required to be paid for. And it guarantees that the property is free of any previous claims or liens, as well as title insurance can protect you for the future of liens and titles. There are people out here that wait for properties to close, and they will open up a line of credit on your home, and you could be fighting that for years to show that you're proof, or they might try to transfer over title just by the transfer of the title. With title insurance, it protects you from those type of nuances. There have been people out here that had to fight legal battles, even though they never took a loan out on a house, but somebody else could have took a loan out on their house. And if they don't have title insurance, they could be fighting those court costs to themselves, not to their other party. So these are the types of things that you want to think about when you're thinking about purchasing title insurance. Homeowner insurance policy, this is required before you can close on a property, and this is just to protect the insurance company to make sure that that home, if a storm came by and a tree knocked down the entire house, that homeowner's insurance policy will protect the lender's contribution to that property or the lender's equity into that property. It is required, and there are different different policies, so you can definitely check them out and see which one is best. And closing funds, you must bring all your closing money or funds that's agreed upon, and typically that's provided to you 2 days prior to closing in an alta form. So you have to have a 2 days head up on your alta form that tells you exactly what's required for your closing costs that you must bring to closing table via either electronic wire or a cashier's check. So just keep that in mind, ladies and gentlemen, so that you'll know these are the types of things that you use when you're purchasing a house. Now, keep in mind, when I'm telling you guys about all these items, typically what it takes to get into a house and close on a house is typically about 7 to 8% to close on a home. So when you're thinking about purchasing a house, that's what your number is 8% of the sales price. You're typically going to have to come out with liquid cash. I know a lot of people say 3.5%. That's all you need. Those are in special circumstances, or whether you can either get a seller to contribute towards your closing costs, or if you can find some down payment assistance, or if it's a USDA approved home where it's 100% financing, all you have to do is help bring in the closing costs. So there's a different array of ways where you can alleviate some of that liquid cash out of pocket, because I do believe that buyers should be able to keep as much cash as they can in their physical pockets. FHA MIP mortgage insurance premium. So this is more in depth about the mortgage insurance. FHA insures loans to protect the lender against losses and results from defaults on your mortgage. So when you don't pay your mortgage, that's your default. Depending on the terms and conditions of your home loan, most FHA requires that for the life of the mortgage. And it's broken down as this. If your base loan is greater than 625 and your loan to value is 95, your annual could be 90. Your annual could be 80%, 0.80. So it's all dependent on it. This is a breakdown of whether your loan to value ratio is greater or less than, and that depends on what you're going to be paying on your annual PMI percentage. Debt to income ratio, and this is one of the most qualifying factors that you will have when you're trying to purchase a home. So 3 things that it takes to qualify for a loan through any lender. It's going to be your income, credit, and debt to income. So how much debt have you obtained and how much income you are making? So your debt to income ratio is a percentage that shows how much of a person's income is issued to cover his recurring debt. Lenders typically, if you're a W-2 employee, they can use pre-tax income. If you're a 1099, they're going to use based off of your tax return, what you wrote off. So if you said I made $100,000, but I only cleared 67, that's the only income they can use is the 67. Whereas a W-2 employee can use pre-tax income. There are 2 numbers that the FHA use that qualify, and this is FHA or conventional. It's going to be a front end and a back end ratio. The front end ratio looks at the housing related debt, only monthly mortgage payments and property tax, HOA, etc. So they're looking at your monthly mortgage payment, your property taxes, your HOA. I think that's it. Your tax. You got taxes in there. That's pretty much it. It may be some other things that I'm not too familiar with, but that's going to be your front end. That's everything that is house related. That's a recurring debt that you would have to pay. Your back end number takes all your monthly recurring debts into account. This includes your credit card, your mortgage payment, your car loan, because this is the back end. This is the total debt that you're going to have to pay monthly. So your credit card, and how they calculate this is the minimum payment. So if your car payment is 380, they're going to take 380. If your credit cards is $100 minimum payment, and you have another credit card that's another $100 minimum payment, that's what they're going to take. So now you're at 580 on your car payment, your credit card. You have to also include your insurance, your if you have any student loan debt, say for instance you got $90,900 will be added included to that DTI. So this is how you calculate your debt to income ratio. And what they can do is just calculate that via looking at your credit report and seeing all the debt that's under your name and seeing your minimum payments. And then they're going to calculate that and say, hey, this is your DTI. I mean, you're at 33. That's a great DTI to have. So I got a lot of wiggle room. I can put you up to, for FHA, I can put you up to another whole 10%. And you can afford about 10 more percent to add it to your liquid debt. So keep in mind, the least your debt, the greater you can purchase. The more your debt, the less you can purchase, or the less you can qualify. I also showed an example of how you can calculate your debt to ratio below. So if you have any questions, you can use this as a resource and kind of utilize that. If you need this PowerPoint, please feel free to reach out to me and I'll be able to provide that for you. But when you're also thinking about your debt to income ratio, I told you guys that I'll give you like some nuances on how to absorb some of that debt to income ratio. For instance, if you are married and you know you need to buy a house soon, and you guys just found out that you got to get a new car, typically what you want to try to do is put that new car in either your wife's name or probably your mother's name, just until you purchase the house, so that the lender doesn't have to affect that your debt to income ratio if you want to buy a particular house or a particular purchase price. So you have to keep that in mind when you're thinking about those type of things. Like, you can maneuver debt. You can transfer debt into somebody else's name, like your spouse's name, in order for you guys to release or to dissolve some of that debt. Especially if you're going to be the one that's qualifying for the mortgage as the primary borrower, and you're not going to put the other counterpartner onto the loan. And just a little short nuance, you do not have to, just because you're married does not mean that your wife has to go on the loan. She can still be placed on the deed and she will still have the same ownership rights as you. It just means who's paying for the loan, who debt is that in. So keep that in mind when you're purchasing a home. Your DTI or your debt, just because you're on the loan as the husband, does not mean that your wife cannot be placed on the deed as part ownership of the house. It just means that you're financially obligated to pay for that house. So you can maneuver some of that DTI around. This was what I was speaking in regards to your debt to income ratio, and getting the higher ratios. And I can provide this for you, but no credit score below, or no credit score may not exceed 31 to 43 ratio. Energy efficient homes may stretch ratios up to 45. So FYI, a lot of people are out here and they're looking at new construction or resale. New construction can actually increase your debt to income ratio higher due to the fact that it is more energy efficient. So they know that you'll be saving on utilities. It may not be a physical utility bill that they can physically foresee, but they know that the way homes are built now and designed, they're a lot more energy efficient. So you're going to save certain percentages on energy bills that you're typically going to pay when you're typically in a regular resale home. That's going to be higher. 580 and above, there's no compensating factors required. Energy efficient homes are still going to keep you at the same ratio. 580 and above, you got 37 on the back end, 47 on the front end. Want to file and verify documents of cash reserve, minimum increase in housing payment, or residual income. So when Ty's out here trying to teach you about how to build residual income, how to leverage your income, or to purchase investment properties, These are one of the factors that can help you to get a higher DTI. Because if you have residual income, guess what? You're always paying. You're always getting money paid in. That's a great way to do it. Verifying document and cash reserves. How much money do you have in a reserve bank for yourself if something goes wrong in trying to purchase a home? If your current rent payment $1,600 and you're only going to a mortgage payment of $1,800, it's only a $200 difference. That's a minimum increase. I mean, so those are the types of nuances you want to got. If you want to get up to the 40/40, no discretionary debt, or two of the following. So that's what I have for you guys today. Thank you for my thank you for you guys' presentation. If you guys have any questions or any concerns, feel free to let me know. I appreciate you guys coming out, watching our video. And this is FHA Loan. Thank you and have a great day.